Hey everyone, welcome. It is, we just had the closing bell for February 20th. I just got out of a meeting, so I have no idea how we closed, but at least earlier in the morning, the market was really struggling. We were down and then we continued to move down. So we'll see if the market recovered at all during the day or if we closed at the lows. So let me go ahead and share my screen and take a look at how we developed through the day. So we recovered. We recovered quite a bit, actually. So our open is over here near this purple line right here. We recovered most of what we lost. We did initially move upwards towards the previous day close, just as statistically we tend to do, but we did not get all the way to the previous close. We only got as far as this first purple line, and then we started trading way down, and it looks like a little bit, maybe around 10:30, we started to recover a little bit. So that is good news that we didn't close at the lows, especially over here on NVIDIA. NVIDIA followed the market, but was actually a little bit weaker than the overall markets. It recovered about half of what it lost. So at least we're not closing on the lows. There's not a lot of necessarily negative sentiment about NVIDIA earnings that are coming up, although that is Wednesday after market. So tomorrow's session will be more telling. We started to follow NVIDIA, Amazon, and Apple because those are the ones we identified as higher risk to the overall markets that could drag down indices if they decided to move significantly lower. And Amazon just barely closed above its VWAP. NVIDIA barely closed above its VWAP. Apple did make it comfortably above its VWAP. So we are still continuing to see signs of weakness inside of this market. And now is a good time to consider another hedge on our portfolios if you're not fully hedged already. So let's see how that looks on a daily basis. NVIDIA is down below its EMA 8. Didn't quite make it to the EMA 20, but did retrace about halfway back. So that's good news for NVIDIA. And it looks like in one of our systems here, the Profit Almanac, we were expecting a move up to at least 653, and we well beat it. And then now we pulled back today. So even the close is well above where we expected on the system. So this system would have been a really big winner on NVIDIA. We'll see what happens after earnings. SPY, we did not make it all the way to EMA 20. So our expectations were met on the SPY, where we did open below the EMA 8 and stay below the EMA 8. And during the day, we did go further down, but we never quite made it to the EMA 20. So exactly what we were expecting this morning. And when we traded back up, we're still pretty close to that EMA 8. It's not quite a doji candle, but there is a very small body on this one. And tomorrow, we may see it creep a little bit lower. Tomorrow, it is possible that we could touch that EMA 20. And then for sure, we want to be sure that our portfolios are well hedged. So it's a good idea to plan that hedge tonight and then trade that hedge tomorrow morning if you're not fully hedged quite yet. If I look at the Dow Jones does have a doji candle, so it's open and closed very close to its EMA 8. So it also never quite made it down and touched its EMA 20. So that's really good news. Defensive sectors seem to have done pretty well today. And we can look at those sectors more closely in a few moments. Look at QQQ. QQQ traded all the way to its EMA 20 and below it, but we closed right at the EMA 20. So far, it is looking like that EMA 20 is holding. We're touching exactly this trend line right here and the EMA 20. So for sure, if we're going to put on hedges, we want hedges more on the QQQ than we do on the SPY or the Dow Jones. So in other words, we want to be, if our portfolio contains tech stocks or consumer discretionary stocks, we want to have a hedge on earlier than if we did not have those on. So we want to make sure that our portfolios are well protected if we're investing in those particular sectors. The TLT, let's see what happened with bonds. Bonds just chopped sideways. Okay, so nothing yet in terms of bonds. If we see this break below that purple line, then we will, at this point, it is a clearer picture than what we were talking about before. So now it is pretty clear that if we break below this purple line, then we are going to have the beginnings of a change of trend within QQQ, and most likely the beginnings of a change. We will break this trend line in both the QQQ and most likely the SPY as well. So that breaking this trend line by itself does not necessarily mean the change of trend. It signals a change of trend, but it does not confirm the change of trend. So for the change of trend, we want a lower low and a lower high. You could sort of say that this was a higher low and a lower high. That's not it. That's not quite yet. And also this high was above the trend line. What we want to do is we will come down here, and then we will for sure at that point be at a lower low. And then we come back up here, and if we get stuck at the trend line and bounce back down, then that would be a lower high below the trend line. That would be the confirmation of the change of trend. So we still have a little bit to go in order to confirm this change of trend, but we are at the first danger zone in the market right now, at least in QQQ. We're pretty close to it in the SPY and the Dow Jones as well. So we definitely want to really start exercising caution. We don't want to have our portfolios pointed too long, and we want to make sure we really start hedging our positions. And when I say that, we don't necessarily mean that we completely hedged or that we're not switching the direction of our portfolios. At worst, we are going neutral and waiting this period out. Or you can continue to point upwards, because there is also a chance that we bounce off of this and we continue higher. There's no guarantee that we're going to break through this. So you can either go flat and go neutral and sit on the sidelines and be safe, or you can say, hey, we're still in this uptrend. We could bounce. There's a higher probability of us bouncing and moving upward than it is of us breaking this at this point, although we do have a lot of signs that there is weakness in this market. So personally, if I had a choice between the two, I would start moving my portfolio more and more neutral. Hedging helps you get to that neutral point. So having your portfolio pointed upwards and having a hedge does neutralize you. So it doesn't mean get rid of all your positions and sit in cash, although it could mean that. That's your own personal choice for your own portfolio management. Or it could mean I have a long and I have a short, I have a long and I have a short, everything is paired up. There's many ways to approach this, but we want to start to get more neutral, if not completely neutral at this point. We looked at TLT. Let's see what happened with VIX. VIX stayed up, so we opened around 15. We ended around 15 and a half. So we do have elevated VIX, which makes sense because we have a down day. What will be really interesting is if we continue to see VIX creep higher, if we get a high day or a sideways day tomorrow. If we get a down day tomorrow, then we should for sure, we would see a increased in the VIX. But right now in the S&P 500, what we're expecting tomorrow is the possibility of coming and touching that EMA 20 or this trend line right now. So we're not really expecting that we're just going to fall and break through this trend line unless there's some weird, crazy news, unpredictable news that happens. So for now, it's probably going to look very much like the QQQ. We're just lagging the QQQ a tiny bit, and we'll come down and possibly touch that trend line. We don't have to. We can move upwards. That would be more of a sideways trading within the S&P 500. We would just move upwards and get stopped out at these highs right here. We're probably not going to have that big of a bar. So maybe a couple of days moving upwards and hitting that high, or a couple of days moving down and then challenging this trend line right here. So what we were talking about last week was that we were going to reach a decision point pretty soon. We are getting squeezed between this trend line and this all-time high right here. So there is going to be a break either below the trend line or above that all-time high. And right now, we don't know which way it's going to go, although there is a lot of signs that this market is weakening. However, we still have the possibility of this second psychological resistance and this 25% move, which we would be a lot more confident in that we'd have difficulty breaking above. Right now, this all-time high is a challenge, but it's not necessarily a super hard challenge for us to overcome. The second psychological resistance becomes a much more difficult challenge to overcome because of we have the indication that the market makers may be running out of the cash, and in which case they have to start selling. So right now, just because we touched this trend line again, we're not going to get too excited, but we are more cautious than the last time we touched and the last couple times we touched. So this one touched, and in a single day, it popped right back up. This one we haven't touched yet. So we really want to see how the market behaves when it touches tomorrow, or if it touches tomorrow, I should say, not when. And the QQQ has already touched, and it just sat right on top of it. So it wasn't this immediate bounce off reaction like we did the last time. It looks a little bit more like this one, but you see that this one didn't break through the EMA 20 either. The next day was up. So we're not going to get too excited about the fact that it's sitting here, but we're not going to get overly cautious because we came and we touched this, but we're going to be appropriately cautious given that we have more signs than the previous times that this could be a topping out action. We are at a risk point and we want to be prepared, but we don't want to jump the gun and get ahead of ourselves. There is still the distinct possibility that we're still going to bounce off of this and still chop sideways. But like I said, it can only happen for another week or so before we have an absolute decision of whether we're going to break upwards or downwards. So bonds, VIX, let's take a quick look at CPC. CPC is still at 25.75, so that probably hasn't updated yet. We'll see if the fear and greed index has updated. 68, so coming down, so weakening inside the fear and greed index as well. So overall, we just have this sentiment that we're going to be more and more cautious until we see what happens over the next couple of days. And then, of course, we have the NVIDIA earnings over the next couple of days as well that we're going to pay careful attention to, because NVIDIA they just surpassed Amazon and Google in market cap. So their influence is really large in the markets right now. So let's see on my stock fetcher, let's find NVIDIA. Well, I guess we might as well look at the sectors first, since I'm going to have to bring up the sector scan anyways. So well, just to see what did well today, XLP, so defensive in the spotlight, bonds in the spotlight, utilities, again, more defensive in the spotlight, materials, that all of these are very defensive sectors. So we've been flipping back and forth between tech and defensive, tech and defensive, tech and defensive. Last week was tech, right? If I go one week ago, well, I'd have to do 1 week ago on Friday. That would be in the past week. So I guess 2 weeks ago. 2 weeks ago, we were looking at I want to look at the 1 week performance 1 week ago. Okay. All right. So tech was up, and now currently our defensive sectors are up. What's interesting, though, is that this entire time we've been flopping between tech and defensive sectors. We've been making new highs. We go defensive, and then we flip to tech, and we make a new high. Then we go defensive, we flip to tech, we make a new high. We go defensive, we flip to tech, we make a new high. Now we are flipping to defensive. And then if we flip back to tech and we don't make a new high, we're just flat again. So actually, I should say, when we flipped to tech last week, we didn't make a new high. We went flat. So that is another sign of weakness inside the markets. So there's just a lot more evidence that we're really starting to top out over here. And again, we don't want to jump the gun. We just want to be very, very cautious. So let's actually take a look at, well, we were going to look at market cap. We'll look real quickly at market cap, and then we'll take a look at a possible hedge. So let's take a look at market cap. We've got Microsoft, Apple, Google, and NVIDIA. NVIDIA, so after today's market action, NVIDIA was down almost 5%. So that brought them back below Google, but still above Amazon. So if I go back to Friday, well, according to my scan, Google was still above NVIDIA, but according to news headlines. So I don't know. I'd have to do my own research and figure out which one's correct. But in any case, NVIDIA is on the top, right? Top 3, top 4, and it has a heavy, heavy influence. And it is the number 1 performer in the Magnificent Seven and the AI stocks and in the chip stocks. So if we see a breakdown in NVIDIA, that is going to have a large effect on the QQQ, and that will bleed into the S&P 500. So this is going to be very important earnings to watch. So we might hedge against NVIDIA crapping out, or we might hedge QQQ breaking below the trend line, or we could hedge S&P 500 breaking below their trend line. It just depends on what is more appropriate for our portfolio. What are we actually holding inside of our portfolio? Now, if we say, well, I'm not too sure, or I don't have any idea, then really all of them are pretty highly correlated. NVIDIA for sure is highly correlated to the QQQ. QQQ is correlated pretty highly to the S&P 500. So if any of one of those crack, the other ones are going to crack also. So it's not going to be a big deal which one we choose. We could choose NVIDIA, we could choose S&P 500, we could choose QQQ, we could choose VIX, we could even choose TLT if we wanted to, because that would be correlated with the break below that purple line that we were showing earlier as well. So let's just pick one. And since it looks like QQQ is the one that is most immediate, I'm going to pick QQQ. So what am I protecting against? I'm protecting it against a break below this trend line. Okay, well, we're right there. So how far below? How far below would be normal? How far below would be abnormal? So if we're trading at a 5.5 ATR right now, a 5.5 move below the current level at 426. So I would say down to 420 is a normal level for a single day. In a given week, I can do a weekly chart and I can say, okay, a 12-point move is going to be normal on a 1 week basis. So what's my time frame here? If I say 1 week, then down to a 414 is going to be normal. So 414 is almost to the MA50. So we're defining an MA50 move to the MA50 as a normal move in a given week, but maybe that represents a lot of damage to my portfolio, even though it's a normal move. If my portfolio is pointed upwards and we move 12 points on the QQQ, that can still do a lot of damage to my portfolio. So I either neutralize my portfolio, or I can say, okay, even though it's a normal event, I want to hedge against that normal event. So I'm going to define my break as a move below the trend line rather than a move to the MA50. And then a likely move would be all the way, if this breaks, if that event happens, it's fairly likely that we're going to move all the way to the MA50. So I will make my price assumptions based on that move to the MA50. So I will go over here and I'll say, okay, do I want to protect for 1 week? Do I want protection for 2 weeks? How quick of a move am I protecting against? So in this case, we identified everything on a 1 week basis. So say, hey, if we move to the MA50 in the next week, that's what I want to protect against. So I want to buy a little bit more time than the move that I'm anticipating, unless I'm willing to lose the entire value of my hedge, meaning I'm allowing my hedge to reach $0 before by the end of it. So I might be comfortable with that depending on the price of my hedge. And if I'm not comfortable with the price of the hedge, then I need to buy more time. So let's just look for 1 week for now and assume that I'm comfortable with losing the entire hedge. And if I'm comfortable losing the entire hedge, so let's say the end of next week would be February 28th. Okay. I already have a hedge on. We're going to ignore that, and we're going to see what we're just going to based on our scenarios here. So we said that we would move to this level, which is 414. So actually, I wouldn't want to go below 414 because if we do not hit, for example, 410, which is the position I have on right now, then this value will actually go to zero by next week. So if I say out to 428, oh, Feb 28 is Wednesday, so I picked the wrong one. I need to go out to March. So if we didn't hit 410 by February 23rd, that option goes to zero. And so this hedge was not designed for the scenario that we're talking about right now. Is this hedge was put on for different purposes. So over here, we're talking about, we're hedging for one, I guess if I choose March 3rd, I'm hedging for a week and a half, which is fine. A week and a half is fine. We'll go to the end of the week. And how much do I want to spend? Okay, so how big is my portfolio? Well, let's just say because I'm allowing this to go to zero, do I want to lose $500? Maybe not. It just depends on the size of my portfolio. Am I okay with $300? Am I okay with $200? Or am I only okay with about $100? So we said that we don't want to choose a strike below 415 because of the possibility of us going to zero, because our MA50 is right at that 415 level. So I'm going to stay above 415. So am I willing to lose $200? Maybe I'm willing to lose $250. So let's look at this 418 strike right here. And we say at the March 1st, if we go down 12 points to 415-ish, what is this going to be worth? Well, this is only going to be worth $3.25. So that's only 75 cents on my 250. That's not a great reward to risk ratio. Now, the reason it is that way is because I'm assuming all the way out to the last day of the expiration. I said I'm going to buy protection out to March 1st. So actually, what would be better is, what am I really afraid of? What I'm really afraid of is really fast, rapid action down to the MA50. So tomorrow we break. That's Wednesday. The next day we continue downwards. On Friday we continue downwards and we hit the MA50 by this Friday. That would be devastating, perhaps, to my portfolio. A lot more so than if it happened over a couple of weeks, because I have the time to react, to move my positions around, to neutralize my portfolio, to flip my portfolio to the negative side since we broke the trend. If I give myself all the way to March 1st, there's a lot of time in there for me to adjust my portfolio. But if this hits that MA50 in the next couple of days, that's not a lot of time for me to react. So what we're going to hedge against right now then is not the movement down to MA50 by March 1st, is actually to this Friday. So I'm going to adjust this. I'm going to keep the same expiration. So in this case, I'm buying a little bit more time than the amount of time I want to hedge for. And then I'm going to adjust this to the end of this week. So February 23rd. Now let's see that same strike. We're buying in at around 250. What would it be if we hit that MA50 by this Friday? And it would be $6.50. That's about 150, 160% growth. So 220% if I'm looking at the pure mathematics of, if I'm looking at a reward to risk ratio, it's about 2.5 or 2.6 to 1. If I'm looking at the percentage gain, then I subtract 100 from that. So it'd be a 150% gain. So that is not bad. 2.5 to 1 is not bad. It's not the best. So what if I said, hey, I'm going to allow all the way up to 415 because now I'm not afraid of expiring and go to zero. because my plan should be, if I'm only protecting myself out to this Friday, my plan should be that no matter what, if it's made money or if it's lost money, I should be closing this particular hedge on Friday because I'm only buying protection. I'm only using it as protection all the way out to Friday. So I definitely don't want to hang on to it into the following week. So if that's my plan and I stick to that plan, then I can go out to 415. I can even go a little bit lower if I wanted to. So here at $1.90 becomes 508. That's roughly the same reward risk ratio. There's not a lot of benefit to me for doing that. Over here, this would be about 2.75 or 2.8 to 1. Is it worth it going that far out? Probably not. So right now, with the particular event that I'm looking at this expiration, the best protection I can get is at probably around 3 to 1 or 2.5 to 1 reward risk ratio, depending on how far out I want to go. So it's a little bit more conservative, and I will lose money from my hedge at a slower rate if the closer to in the money that I get. So less out of the money is more conservative in terms of my rate of decay in my options on my hedge. And maybe I prefer to lose money a little bit slower than a little bit more quickly. So we'll just stick with this 418 strike right here, since there wasn't a whole lot of benefit gained by going further in the money. It's only about 0.25 on the reward to risk ratio. So let's pop this into option strat. It's the March 1st expiration 418 strike put. Wrong. Okay. So I'm buying a put in the SPY on the March 1st 418 strike put. No, QQQ. 418 strike put. Okay, so we will save this trade. This will be a pre-post market hedge to 223. So on February 23rd, on Friday, we're going to make sure that we take this off if we haven't taken it off already. So we'll pay attention to this, and in either the pre or post market between now and Friday, we'll take a look at this again and see how it's performed. Like, did it protect us? Did we buy short? So if it loses money, how much money does it lose? Was that within our expectation? Because it's just insurance. So actually our expectation is to lose that money. And we already designed it that we're not going to lose more than the $2 and $250 that we put into it. So we're not going to lose outside of our expectations. It's impossible. We set it up so it's impossible for us to lose more than we were willing to, which is great. So we already know that side of the equation. We just have to see, hey, does the market actually break down and tank, and does it protect us the amount that we wanted to be protected? Okay, so that's the only unknown right here. So be careful. We're more and more cautious. We're still above the trend line, and we are either neutralizing our portfolio, or if we're pointed upwards, then we're doing hedges like the one that I just showed you, or the VIX hedge that we had last week. Right? So we'll see what happens tomorrow if we continue to move downwards, and whether the S&P 500 challenges its EMA 20 as well. So have a wonderful rest of your day, and I will see you guys tomorrow morning.